Hello and welcome into the KE Report. Chad and Corey here, getting an update from Chris Temple, editor and publisher of the National Investor. And Chris, it's always great to have you on the KE Report to pick your brain on how you're looking at the macro, how you're looking at the micro with some of the resource stocks. But we have to start with the Fed meeting today and your takeaways from Powell's comments and press conference and how you're reading the market reaction from Fed Day.
Well, by and large, Shad and Corey, I think that the Fed was a bit more hawkish in a sense than what the average Fed watcher was expecting ahead of time. The markets, however, at the end of the day, held most of their gains from this morning after this morning gave, for a change, a cooler than expected inflation reading, where for most of this year we had warmer than expected ones. But the big takeaway is that in March, and they update this every other Fed meeting, so roughly quarterly, in March, they were projecting a median of three interest rate cuts of 25 basis points each for 2024. They went past two, and now they're down to just median expectation of one cut for this year. And four of the members of the FOMC are said zero. And beyond even that, as Double Line's Jeff Gundlach was pointing out in some of his commentary right after Powell's press conference, Powell was, number one, very vague in what he said, according to Gundlach, and I agree with that, but more so really trying to convey the message without coming right out and saying it, that this softer inflation number this morning really doesn't mean much to them. And they are so fixated on making sure that when they do start cutting, that it's the right move, that they are willing to risk waiting too long as opposed to moving too early and then having to undo that. That really is what the takeaway should be today on people's parts and on investors' parts. But investors, and we see this time and again, they want to look at the glass half full. They've got this idea that we're in a binary world, and once the Fed starts cutting interest rates, we're going to go all the way back to zero and more quantitative easing and so forth. And they don't understand that there's a different world that we live in today, and it's not a world of really disinflation. It's not a world of going back to zero interest rates. It's that for as far ahead as you want to look, we're going to have chronically higher inflation and interest rates will stay elevated for quite some time, especially market interest rates.
Well, Chris, isn't the whole point here too, even if when I guess we do get one rate cut this year, it isn't a series of rate cuts, but it is a bit of a trend change from a few years ago when rates were going higher. That's maybe why markets have been a little bit more mixed in a sense, especially kind of the small cap stocks where we can't depend on rate cut after rate cut. It's going to be slow when we do start getting rate cuts, much like we heard from central banks last week.
It probably will be slow. And again, one of the things people need to keep in mind, and this is part of the reason for Powell occasionally waffling, besides the fact that he's a Federal Reserve chairman and waffling and obfuscating as part of the job description. Okay. But beyond that, Powell's self-confessed phobia is that he does not want to make the mistake that Arthur Burns did in the 1970s. When Burns was Fed chairman, he first let inflation out of the bag after Nixon took us off the gold standard and he started printing money, debauching the dollar, inflation went up. Under political pressure and because there was a lull in inflation's rise, he stopped raising rates, tried to cut them, but then inflation reaccelerated and he had to raise rates arguably more in the end for as long as he did it before Paul Volcker came in later and really did the job than might have been the case otherwise. And that's Powell's biggest fear today. He's already screwed up big time by unleashing this inflation beast in the first place. People can't forget that whatever he says or politicians of party say to the contrary, the Federal Reserve in a little over 2 years' time created 30% of all the dollars ever issued into existence in the history of this country. You don't do that without unleashing higher inflation, and we got it. So he started that. And so now his concern is, after that big boo-boo, is he doesn't want to do what Burns did and give in to political pressure, give into the pressure. Well, other central banks are cutting rates. You got to start cutting rates and then stop. So to your point, Corey, what probably will happen when the point does come late this year, early next year, whatever, that the Fed does see enough evidence for it to cut rates once or twice. It's not going to be billed as a cycle. It's going to be billed as, and we've heard this term a number of times recently. It's going to be more like a mid-cycle course correction. We're going to make an adjustment. Okay, 5.25 to 5.5%, where the Fed has been for nearly a year now on the federal funds rate. Maybe that's not as necessary. We're going to take 25 or 50 basis points off of that, but then we'll sit for several more months. Okay, the markets, I don't think, expect that. The markets are spoiled. And again, they've got this binary thinking where once the Fed starts, it's going to be 25 or 50 basis points a whack until we get back to zero. That's the way the markets are behaving with all of this froth. And in the end, they're going to be disappointed, but you don't try and tell anybody that now.
Chris, I think that's such a great point because coming into this year, when the markets were really the end of last year, we should say, the markets were expecting 7 different cuts this year. Now that's gone down to 1 to 2, but the markets have stayed elevated despite that, kind of on the idea that the economy was better, that we didn't slip into a recession. But if we have these higher interest rates and they only end up cutting 25 basis points or 50 basis points, we're still going to have higher rates for longer. What does that do to business loans as they roll over? What does that do to municipality loans as they roll over? What does that do to the mortgage industry? What does that do to the auto industry? How will the higher rates for longer really play out? And are the markets maybe getting too optimistic here that they're going to get that series of cuts when they may get just that mid-cycle correction?
Well, Shad, they are being overly optimistic, and inevitably we will see, and Powell said this today, that, and I'm paraphrasing, but they do view policy as restrictive. Is it restrictive enough? Time will tell. They still have teased, even though it's nobody's base case, he said, you cannot take out of the realm of possibility that they hike rates is their next move. Okay. And that's a discussion for a different time. But the situation you have right now is that there is some sign that this restrictive policy, and I'll put restrictive in quotes because you can't tell you it's restrictive by looking at the financial markets and even some areas of credit, but consumers are feeling a pinch. Inflation is biting hard. People are starting to pull in their horns on some discretionary spending, even though by and large, consumer spending has stayed decent. Unemployment has ticked up a bit. The job situation, the market has weakened somewhat, though it's still healthy in relative terms, all this kind of thing. And over time, what the Fed is betting is that by keeping rates elevated or maybe just trimming them a little bit late this year, early next year, and then sitting again, that nature will take its course from all of these rate hikes to date, and that on its own volition, the economy will slow down and bring inflation with it without that translating into a crisis or into outright deflation. That's their bet. One of the cushions they have that protects this bet in their mind is that they started this whole thing from that place of having printed so much money with COVID as the backdrop and the excuse that they got a lot of room to make mistakes. They've got a lot of leeway and I think a lot of cause to take the position, which they are right now, that they want to err on the side of starting to cut a little bit too late, then jump the gun and repeat that Arthur Burns type of mistake. And it's all because there's still so much liquidity. Jeff Gundlach I referred to earlier. The point too, which I've made several times, that if you look at the broad money supply growth, M2, which for a while, because of all that, immediate post-COVID money printing went parabolic, even with M2 coming down for a while, but recently having turned back up, we are still well above the long-term upward trend of M2 that we had before COVID. So this idea that the Fed is being restrictive, that's why you got to put restrictive in quotation marks. There's still a lot of liquidity out there. But as time goes on, that liquidity is going to go where it belongs. And this, I think, guys, is going to be all else being equal and barring any black swan event that torpedoes everything for a while. This is going to be one of the long run benefits of getting back at least somewhat toward a more sane world where you've got a decent level of interest rates, where investors and lenders and creditors, debtors alike have to make real world decisions and not decisions just based on 0% interest rates. You will see money go where it belongs. Deserving borrowers will be able to get it. Undeserving borrowers will have a tougher time. Now, if we can do all this and bring back this more sane world without a deflationary accident of some kind, that's still an open question because there's an awful lot of evil that having 0% interest rates for so long created, a lot of moral hazard that enabled, and we haven't reckoned with all of that yet. Every now and then you've had a bank go bust here and there, but just in the news in recent days, once again, you've got warnings, and to your point, as a lot of borrowing costs roll over, whether it's on commercial real estate or other types of things, but commercial properties, the big elephant in the room, it's getting tough to do it. There's a lot of fire sales of assets right now. And I do believe that parts of the real estate market, mostly commercial real estate, because residential real estate, at least in the US, is not nearly as bad as it was 15, 18 years ago, that you are going to see with commercial real estate in some of those parts of the market in the US, a situation similar to what China has been trying to deal with for the last few years now, where everybody got so over leveraged and because they first got so stupid as to borrowing money that they couldn't pay back, building stuff that wasn't needed, et cetera, that we are going to see some stresses come up in the banking system. And so we don't have to worry about this tomorrow or next week or next month necessarily, but looking later this year, it's certainly as we get into the next year or two, are there going to be some cracks that are wide enough that open up with bad debts and stuff that it forces the Fed's hand to ease more than they might otherwise, even if inflation is not back down?
So, Chris, you do sound generally bearish on these markets because of some of those facts that you have outlined. And who knows, maybe a crash scenario is developing, but does the Fed even have control over this? Are we looking in the wrong place trying to dissect one, maybe two rate cuts, maybe even into next year because of the fact that, well, the world is bigger than just the Fed?
Well, that could be, and there's a lot of things that are happening these days that, the three of us have talked about before, and we just talked about off mic before we recorded today. Globalization is unraveling. We're going to a multipolar world. The pricing level of commodities is going to be much higher down the road. All of these things argue against the notion that the Fed can successfully take us back to 2%, long run inflation. It's almost a mathematical impossibility, frankly, not to mention what these blowout federal budget deficits have done in this country to themselves add to the inflation problem. We're well over $1 trillion a year now just in interest costs on a national debt. Neither the Democrats nor the Republicans on Capitol Hill have any intention or desire at all to even slow down this runaway freight train, whether it's domestic spending or spending on conquering the world, as they always do. So, there's a lot of reasons why we're not going to get there. And I think, Corey, to your question, there's this verse in the Bible where Jesus criticized people for straining at a gnat and swallowing a camel. And yes, we can strain at all these gnats in the form of, every little economic hiccup and nuance and every dot and tittle on the inflation numbers and the employment numbers and wage numbers, but miss the big picture. The big picture being is the Fed can't take us back as a matter of simple mathematics to that pre-COVID world, but the markets are of a mind that is ultimately where the Fed's going to get dragged into. And how and when the realization sets in the markets that we're back to somewhat of a more sober world, the world itself is changing, the world order is changing, we're going to that multipolar world, trade has changed, all of these different relationships have changed. all of the factors that gave us disinflation for 40 years after the peak in interest rates in the early 80s, they're weakening or they're gone. And this is something that the markets simply have not come to grips with yet, that we've got to start baking into our assumptions. Much higher borrowing costs going forward, if for no other reason, and there's so much supply and demand for debt, chiefly from Uncle Sam. So you can even have a scenario, and I've warned of this recently, and I think Powell also fears this. He doesn't dare come right out and say it. But don't lose sight of the fact that the bond market vigilantes, which were nowhere to be found, they belonged on milk cartons for 40 years, they're back. And there have been a few times recently where the Treasury's trying to sell or roll over a bunch of paper that they had to pay up a few basis points in order to sell it. That dynamic, I think, down the road is going to get worse. And don't be surprised if the Fed at some point, especially if it's against their will for some reason, gets dragged into lowering short-term rates, but as a result, long-term rates go higher.
Yeah, Chris, it's interesting to see what's happening in the bond market. It's going to be interesting who's going to be buying these bonds. It's going to be interesting to see if international governments that have been supportive of the bonds in the past and treasuries end up taking some of those treasuries and returning them, looking at other trade alliances. And you're right, the multipolar world does change things up. You made a great point about where the inflation came from and that the Fed was responsible for a lot of it. Yet they always seem mystified, Chris, by where this inflation's coming from. And when we look at both sides of the aisle, it really doesn't matter who wins the next election in the US. They're just going to spend more. There's going to be more fiscal spending. There's going to be more money supply created. So in that kind of a world, you've pointed out that inflation's going to stay higher for longer, that it's going to slow growth, and we're going to be in the great stagflation. I'd love you to share what the great stagflation means for the economy, for the markets, and for the commodities.
Well, stagflation itself is a term made up. It's kind of an oxymoron, or always was until the 1970s, because most people figure that when economic growth slows down or you get a recession or stagnating economy, that inflation goes down rather than up. But the 70s and into the early 80s proved that you can have a weak economy even with rising inflation, indeed caused in the end by rising inflation. And I think that's where we're at right now. We're seeing the economy slow down. It's worse for middle and lower income classes than it is for people that have got a big stock portfolio and are still, feeling pretty good about life. But the official numbers in the last 3 years is that inflation has gone up 19%. And those are very, very, very massaged numbers. In fact, one of the Democrat Treasury secretaries of the recent times, Larry Summers, did a study with his compatriots at Harvard recently at trying to answer the political question, why is it with the stock market at a record high and with inflation having come down in the last 12 plus months from its peak of around 9%, why is there still this overwhelming negative sentiment in the polls toward Biden and his handling of the economy, which means in the end, inflation and the cost of living? And it's because Larry Summers and Harvard, not Fox News, not some Republican think tanks, Larry Summers and Harvard University came out and said, you know what? Real world inflation is grossly understated. This is why the polls are so skewed toward those people who are unhappy with their lot in life and unhappy with the economy. It's because that official 19% cumulative inflation doesn't remotely address what the average household is actually living with. And that's a problem. And that problem is going to continue. It's going to continue for a lot of reasons. The things that we need most in life, food and energy and auto insurance and shelter, they've been going up at the fastest rates. Now, food has relaxed a little bit. Energy prices have not gone up as much yet this travel season as some might have thought they would, although I got natural gas is going to surprise people in the next few months. But that aside, it's still a mixed picture. If you want to go out and buy consumer discretionary items, those are going to weaken in price because people are going to start pulling their horns. If they've got to run the dryer for an extra 15 minutes to dry the clothes, and it's the choice of doing that or going out and buying a new dryer, they'll run the old dryer an extra 15 minutes. if that's a decision they have to make. But you can't make decisions that easily on food and energy and shelter and utilities and car insurance and things like this. So, there's a lot of reasons why these costs are going to stay elevated chronically. What is almost never talked about in any of these settings, including in a Fed meeting today, is what is going to happen to commodity prices in the coming number of years, where across the board, key commodities, whether it's copper, whether it's silver, whether it's energy of various types, they're all going to be much higher for a host of different reasons. I'll give you a quick little anecdote. I was at the New York section of the SME meeting a couple or 3 weeks ago in New York City. The official title was Critical Trends in Mining Finance. I co-chaired a panel on copper. We had a few copper-related companies on the panel. But on a different panel, another copper executive was talking about a lot of the permitting issues in the US especially. And we were talking about the current copper mining going on in the state of Arizona and a few development stage projects that have been hemmed up in permitting in Arizona and elsewhere in the US, most notably in Minnesota. And this one guy pointed out that if you could permit all of these things tomorrow and start construction on all of them tomorrow, you still couldn't do it. You want to know why? The cumulative total, and the number was just for the Arizona projects, the 3,000 people that they need, specialized labor of engineering and mining and whatnot, they're not there. They're not anywhere because there's no labor for these things. So as time goes on, labor costs, and this is true throughout the world, are going to go up dramatically to bring people into these extractive industries to meet the demand for the copper, the lithium, the nickel, the cobalt, everything going forward. The average age of people in the energy patch in this country is over 60 years old in the US. Doesn't mean we're going to shut off oil and gas production next week. So, those are reasons why commodities are going to go up much more in years to come. You've got resource nationalism feeding that. You've got diminishing returns, diminishing rates, meaning you need even more production at the same time that demand is going up across the board for everything. And this is not accounted for at all in some of the more Pollyanna-ish prognostications that we can get back to 2% long-run inflation, including from the Fed itself.
Yeah, great points, Chris. I think we're going to wrap it up there, but there's just not a way to bring on the supply of the raw materials the world needs without seeing, one, prices go quite a bit higher, leading to more inflation. And as you point out, there's just not the labor pool there to bring it on, even if the will was there. So there's a big divorce between policymakers' ideas and the reality on the ground, and we'll see that continue to play out. And I'm sure we'll be talking about that for some time to come. If people like listening to Chris and want to get more of his insights, definitely check him out over at the National Investor. We'll put a link to that down below so you can follow along with Chris's work. And Chris, as always, it's great getting your thoughts here on the KE Report, and we're looking forward to our next conversation.
Anytime, guys. Take care.